Welcome to Bull Bear Brief. It's May 17th. We're covering the market action from last week. I'm your host, Joe Quartucci.
And I'm Arpit Sharma.
And we have a very special guest here with us today, Mr. Connor Capps, who is a private wealth advisor with E3 Wealth and a good friend of mine. I've known him for more than a decade now, watched him develop into a amazing young professional. And recently he has been on Fox 2 a couple of times talking about the K-shaped economy, which is a subject that Arpit and I have covered at great length on the show. So we wanted to get Connor's expert, now that he's a celebrity in the local markets in St. Louis, opinion on the K-shaped economy, and we're going to do that later. But before we do that, as always, every week, we are going to recap the market's action for the week, and we're going to get Connor's take on that too. I'm sure he's got lots to say. Real quick, I'll lead with the market had its winning streak, a streak of 6 weeks in a row, snapped last week. So if you were a bear indicator, like we talked about at the very beginning of the show, bulls and bears, the bear actually won for the first time in quite a while. S&P barely posting a loss of 0.06, Dow down about 0.36%, NASDAQ down 0.19. Couple of things to point out if you're a big cryptocurrency fanatic. Finally, Bitcoin had a negative week at negative 4.6, as we talk about in the show all the time. Bitcoin typically is kind of like a leveraged play for the NASDAQ, so we saw it have some troubles. A lot of those troubles occurred on Friday, Arpit. Do you want
Yeah.
to talk about what do you think is causing that? And then let's hear from Connor on that as well.
Yeah, so there's a few things that we're starting to see. One, there's major talks of bubble-esque, feelings in the marketplace. We mentioned this last time, semiconductors up almost 70%. Now this time we also have higher than expected inflation results. We were already expecting high inflation, but the results were a little bit higher, right? So that's kind of the fear gauge right there. And now we're pricing in, or the markets are beginning to price in, increased rate hikes, not rate cuts anymore, potential rate hikes, which is again just causing a lot of fear. So that's kind of what we're starting to see a lot more in the marketplaces.
What about you, Connor? What are your thoughts on the
No,
winning
I'll
streak
piggyback on
ending?
everything Arpit just said. And again, if we go back to the kind of topic of this call today of the K-shaped economy, I think Arpit just hit the nail on the head, because if we see inflation stay sticky as we have and see interest rates actually go up where people are expecting them to go down this year, that just exasperates the K-shaped economy. And I'm sure we're going to give kind of a definition on that soon, but essentially it's the wealthiest individuals kind of keeping us out of recession right now. Well, again, I'm probably beating the point, but if we see interest rates rise, and that's really going to hurt the lower income folks that really aren't spending already. So I think we may be set up, I don't want to be a doomsdayer, but I know, Joe, you just mentioned that the Bears won, which in our line of work, we never want to hear that. But I do believe that, we're seeing kind of some breaking at the seams here. So people need to be prepared for what we think might happen in the future.
I'll play the devil's advocate and then I'll send it back to the two of you, which is that while the market was negative last week, when you think about how much scary stuff is going on in the economy right now, $39 trillion in debt, the Iran war, the Beijing summit didn't go as well as a lot of the markets would have liked to. We can get into some of that later. But with all of that negative backdrop, and with oil at $102 a barrel, gas prices pushing at $5 here in Texas, so that means in California they're looking at $7. That means Chicago, New York, they're looking at $7. That backdrop has led to a very tepid amount off of the all-time highs. We're maybe 1.5%, 2% off the all-time highs. So the devil's advocate side of this is the markets are still shrugging it off. It might just be because, tech needed to take a break. Arpit, you hit the nail on the head there, buddy. 70% the semiconductors were up year to date, and we're not even at the halfway point yet. And that's coming off a year where we were up 75, 80% last year. So you've got to have some breath that you take. So I think the bull case is that it just got a little bit out over its skis, and it could be more to come. So I don't disagree at all with you, Connor, that there could be some potential landmines laying around out there. But each time that we have seen scary stuff, basically over the last 2009, since 2009, it hasn't taken the market to recover very long. So what do you say to that, guys? What do you say to that? This is maybe just us taking a little rest from what had been a unbelievably hot 6-week run. The S&P was up 17% in 6 weeks.
Yeah.
So what do you say to that?
For me, honestly, it goes back to that debate of overbought versus overvalued, right?
Yeah.
And that's kind of the difference maker of whether or not it's a sustained decline or it's just a temporary pullback. If it's an
Right.
overbought one, you probably fall 5-10%, and you have your little recovery. If it's a overvalued market, that is your larger precipitous declines where you go down to 20-25% range. It's kind of hard to see. You can make an argument for overvalued, but you can also make a really good bull argument for saying maybe valued to slightly overvalued, and that's just not enough. Definitely, in my opinion, it was an overbought market. It was really frothy. You saw a lot of recovery buying, and now you're starting to see a little bit of a pullback. We do monitor hedge fund positions, and a lot of hedge funds are trimming some of their tech riskier holdings. That's just part of this, again, an overbought marketplace, a really frothy, scary environment. What is concerning though is, again, yields are rising. What, the 10 years at 4.5, not 30 is now over 5, 5.12%. So those are concerning things that we don't want to really see. We don't want to see rising duration yields because when a treasury yield rises, then all corporate yields rise, and that makes borrowing really expensive. And we
Mhm.
all know how much we love to borrow, right?
What do you think there, Connor? What do you
Well,
think about bull case?
actually,
I'm just playing the devil's advocate.
I was gonna say, and that's a great segue. One of the things you just mentioned, Joe, is how high the national debt has gotten, and I feel like that's almost been swept under the rug lately. That used to be a huge topic our clients would ask about and everything, and now I feel like it's just gonna keep going up. Everybody's just accepted that as the reality and that we're just gonna print our way out of it, and so that one seems to be a little more looming in my back of my mind than some of the other ones mentioned. But then also going to your point on gas at the pump and everything, I said this when I did go on one of those interviews is I don't think people realize how much oil goes into everything else that's not at the pump. And that's kind of the forgotten piece as well. We say, it's $5, that stinks. Well, everything that we use and everyday materials and everything is backed by that. And I don't see that recovering. Even if the war ended today, I don't think that things are going to go the other direction that fast. I don't think people understand the supply and demand of what's going on overseas there. Kind of going on to bubble comments, really, Arpit, I lean on you a lot more for those types of conversations there. But it does feel like from the AI side of things, we can't have this many companies growing market wise as fast as they are because I just don't see kind of the underlying analytics backing it. I think everybody's excited and wants to jump on the train, kind of going back to the crypto conversation. I mean, everybody got excited about that at the same time and we saw it jump, but was there reality behind that? And I'm not sure that there is. And so kind of again, I don't want to get into recommendations and things on this call, but be wary of that area because again, everybody's just excited at the same time and wants to get on board. But be ready for some of those companies to not be able to sustain like some of the big boys. And so
Yeah.
just be aware of where
Yeah.
your money's going when you are investing right now.
I'm glad you said that, and there's a couple things I want to unpackage there. The first one is about the AI. What I said last week, and I saw the clip that we put out on, and I want to create some clarity on that. The semiconductors are kind of in a different category because there could potentially be demand for semiconductors that goes on well beyond the AI boom. The companies that are creating that boom, that are doing what's called CapEx or capital expenditures, that is not clear. And this is an area that time will prove whether or not those CapEx expenditures were smart or not. So think about the Googles of the world, the Amazons, the Apples, the Metas, these companies that are making huge investments into artificial intelligence and getting the GPUs and spending, I mean, country level sizes of CapEx. You're talking expected to be $2.5 trillion between now and 2031. So you're talking enormous amount of money being spent, not by governments, by
Mhm.
companies. And so there's not an economic model for the companies that are making those purchases yet to show that it's valuable. It doesn't mean that there won't be in the future, but right now there isn't. And so I think that's where that bubble talk comes in. But on the semiconductor side, and I continue to hold to this, and I'm not telling anybody to go out and buy semis. That's not what I'm doing here. But I'm saying that the demand for the product they make, there does seem to be still a lot of slack that can be taken up by some of the lower quality chip makers. And we saw AMD rally last week, and now some of these others are catching up with Nvidia because there appears to be room in the marketplace for not just Nvidia's chips, but some of these other companies that have historically been lower quality. So that's one thing that I wanted to say about what you were saying there. On the oil front, I want to point out that when he says it goes into everything, it goes into everything. It goes into all the products that are transported. So think about them being shipped from China or from Southeast Asia over to the United States, or if we're importing from Africa or South America, all going to come in by ship, which is going to use petroleum products to move those goods here. Then once they get here, they go by train or by truck. So that's going to be some petroleum costs in there as well, or some oil costs in there as well. And then into the actual products themselves that are made. I've got my little headphones I'm wearing right now. This is covered in plastic. These are plastic and rubber. There's oil and gas in that. Have you ever put lipstick on or sunscreen on or any of those things? I hate to sound like the landman, but the reality is we have an oil-based economy worldwide. It is shifting. You are seeing some movement over to green energy, particularly in Asia. They have made a huge move towards solar and wind in Asia, particularly in China. But guess what? The solar panels and the wind turbines, they're made from products that have petroleum in them. So, you can reduce the demand, but you're not going to eliminate it. And so there's going to have to be a reckoning on that one way or the other. And the last thing I'm going to say is that I pay really close attention to the way that things happen with the conversation in Beijing. Anytime the president or the United States goes anywhere overseas, I'm watching and I'm listening. The conversation with Trump and Xi Jinping was hopefully to get pressure on China to reduce the length and duration of the Iran war. That did not happen. In fact, quite the opposite. Xi Jinping came out and affirmed Iran's sovereignty over the Strait of Hormuz. I wouldn't say it was a total disaster, but I would say that it did not. The market did not like what came out of that. And I did hear people talking about, well, they agreed to buy 200 planes from Boeing. Again, guys, if you're listening to mainstream media, they had originally agreed to buy 500, and now they're agreeing to buy 200. That's why Boeing stock went down while everybody else was celebrating this big win about them agreeing to buy planes from us. They're buying 60% less planes than they were going to buy. So it was not a win in any stretch of the imagination. And I think while you might personally be celebrating the way that it looked because you're a patriot, the markets are going to look through all that and say, hey, this was not a win for the United States. And so that's the last thing I want to say on that. And just want to get you guys' thoughts on any of those things that I just talked about.
Connor, I spoke first last time. I'll leave this one up to you now.
All right, tossing it my way. No, I agree with everything you just mentioned, Joe. And frankly, some of that I wasn't aware until you just said it. And I think that speaks to the point that you're making, right? I mean, that's exactly what you're trying to say is that mainstream will, whatever side you're on, is going to kind of pump the information that you want to hear out of that. But ultimately, how does it impact all of us, at the end of the day? And I think that's what's really more important than that. And again, we were kind of told that this was going to be a 60-day war, and what day are we in now? And so, and again, not getting political, I just don't see the end in sight, no matter how much anybody wants to say that it is. And again, I said this earlier on today's podcast, even if it ends today, there are repercussions that are going to happen months from now. And again, a lot of us don't associate those repercussions, later down the road because again, life's happening. We're all doing different things. But I still think that there's a major impact coming from what's going on over there. And we've talked about a lot of positives today, but we have to understand those negatives as well. Or again, we're going to be in for another surprise soon.
Yeah, we did. It's an interesting thing. I read a lot of the kind of the market outlooks from various different firms, and I even read the one that Arpit wrote at the beginning of the year. A lot of them were pretty bullish. We kind of think and thought more of a volatile year. We might end up with a 8 to 16% total return on the year for the S&P, but how we get there could be really bumpy, especially with the Iran war, which is really not in anyone's base case on January 1. What I would say about that is only one of two possibilities now exist. Either companies are going to absorb that increased cost and they're going to have lower earnings, or we are going to pay extra for them. And I talked about this in the show last week. Every chance that corporations have to raise prices, they typically take advantage of it. And they are going to be really slow to bring them down. I had this debate with a couple of the young bucks in the firm. Not even really a debate. I was just telling them the prices aren't going to come down until we, the consumers, stop spending. And Connor, at the beginning of the show, you talked about how the K-shaped economy, the wealthier side, they're just not going to stop spending. They're going to do what they want when they want. They're saving enough money for the future. They're taking advantage of the system that's built for them, and the people on the bottom, the ones that more and more of their discretionary income, and even the middle too, is going to go towards these things that they have no choice. They're inelastic products. Energy is inelastic. Food is inelastic. You're going to do that no matter what. I mean, you can make some decisions that kind of lower the impact of it, but maybe go less places or maybe go out to eat less and eat more food at home. But dad burn it. I went to the grocery store the other day. It's almost as expensive to make a steak at home as it is to get one out to eat. It's no joke anymore. You used to be able to do that. Like, I'll eat at home and and it'll be cheaper. I mean, unless you're going to eat those little frozen dinners that are $1.59 that are just filled with sodium, you want to become really unhealthy. It's tough to even eat from the grocery store anymore and compete with going out to eat. It's not as easy as it used to be. I don't know if anybody else is experiencing that.
No, I agree, and I know now I'm jumping in twice, here, but one of
Nice.
the things too that's kind of the theme of today is we're talking about the AI boom and everything and where that might go. That's also gonna probably lead to layoffs in these companies too. So to your point, Joe, going back to the economy and where spending is, a lot of kind of the lower income people, as we see the rise of technology, are also going to potentially lose jobs. Again, I'm not a fear monger, but we're gonna see that K-shaped economy spread even further and further with some of the things that we're talking about today and again kind of as exasperate this issue. So I just kind of want to toss that in there as well. It's again, we all feel good when the market may go up 8 or 16%, right? But it's what how do we feel? And I don't feel like my clients are they're happy with those returns, but they're not feeling the returns, I feel like, because of everything else that we've talked about today. So just want to
Well,
toss that out there.
it goes back to another thing we talk about too, which is that you got to have your money somewhere growing because if inflation's going to run at 4%, you got to have it somewhere. I mean, I guess that's a good thing, Arpit, that the 10-year Treasury is now around 4.5,
Mhm.
5.1 for the 30. So for people who are looking for safer money, they can get it a little higher than inflation. But I mean, that's a really small gap between what inflation is reading right now, which is likely to continue to rise. By the way, the forecasts are now for 5 and 6% by year end, which is why you have the fear of those higher rates. Talk about last time we saw rates this high, Arpit, and when that was and what that led to.
Yeah, I know it was a interesting time. I think the year was what 2007.
2007. Does everybody remember what happened right after 2007?
Yeah, I don't know. I kind of just short term memory actually.
How does, and also too, while you're going, how do,
Yeah.
I know you do a lot of analysis on this. How do people look at like the projection for rates and things like that? That's two things I'd really like you to cover because that's an area that I'm really good at understanding the impacts and I've got good instincts around this stuff, but I don't really understand, how people forecast rates and how that might change the equity valuations.
Yeah. So okay. So a couple pretty good questions actually, and
Oh, thanks.
stop me when I if I go on a soapbox there. So the first question I'll answer. The second one's a little bit longer one, but the first one is again just talking about the last time rates were this high. Uh, we saw a major crisis, right? And whenever rates tend to increase, we saw this again in 2022. Markets hopefully should decrease. That's kind of the idea. And the whole reasoning is that higher rates means less borrowing means less growth in the economy,
We have a
and
credit
on
based
that.
economy.
Yeah, we have a credit, and US is a very credit based economy, and it does, for the most part, fairly good. If rates are in a stable environment, companies adapt, leverage continues, and growth continues. When rates start to rise quite a lot, companies are slower to adapt to that. They can't borrow as much, they can't take as much leverage, and there you go. You just have your general slowdown. So that is kind of the big thing of what happens. The last time we saw rates this high, it happened to be 2007. The last time we saw rates that high again was in 2000. So every time you see rates start to rise a lot from where it was in the past, you tend to have recessions, which is why you have that big indicator fear when the yield curve goes inverted, there's a recession coming. Whether or not that's really true is debatable, but that is a general mindset is that rising rates leads to slowdown in the economy. Now,
It's
how?
always true. It's just a question of
Yeah.
when, though, right?
Well, and I was going to say to the listeners, then Arpit, they're probably screaming, "Then don't raise rates, right?" But why then do they do that?
Oh
Yeah.
yeah, I mean, so the reason we raise rates is
The
because we want to
market raises rates. That's the
Yeah,
Fed hasn't moved one thing. The market has risen that.
no,
The
it's
market
it, it
decided.
it's all market expectations. And one
Yeah.
thing, listeners, you have to understand is that the Fed hates to surprise the markets. So whenever the markets start to make some type of expectation, is because they understand kind of it's they're predicting on how the Fed will operate, and then the Fed kind of just feeds into that operation in a way. So it's it's who leads who. Is it the Fed
Chicken
leading
or
the
the
markets,
egg.
or is the market leading the Fed? It's kind of little bit in between here.
Yeah.
So and the reason again we raise rates is to combat inflation. And when we talk about we raise rates, I'm talking about on the Fed side. The
Yeah.
reason the Federal Reserve raises rates is to combat inflation. The reason markets raise rates and markets raise anything from 3 months to the 30 year, that's all market based. The reason those rates are raised is because markets are starting to price in a lot of different things. One is future inflation. So you don't only have to look at what current inflation is. There's also data on 1 year inflation expectations, 5 year inflation expectations, 10 year inflation expectations. Those are all rising up and up and up, all as a result of this oil crisis that we're starting to see. So when Connor, you mentioned earlier, that there's going to be a longer term effects. That's getting baked into longer term inflation expectations. That raises yields or long duration yields. Also, another thing is taking into account risk. So we talked about the deficit earlier. As the deficit starts to increase, you're taking on more and more risk in the U.S. government. However minuscule that risk is, there is still some level of risk that again increases yields. And again, just overall general wantingness for the bond. So if there's a lot of demand,
Demand.
if
Yeah.
there's a lot of demand, yields actually go down. If there's not as much demand for the longer duration, the yields actually semi go up.
I think another
So
thing people forget real quick is that we created a lot of the demand for our bonds during the COVID crisis, during the post
yeah,
financial crisis. We were purchasing our own debt. That's called quantitative easing. We would issue the debt and then we would purchase the debt. So
yeah,
we were creating artificial demand. And there is some of that right now. The QE engine has been started back up, but the size of the offerings are much bigger now too. So it's just, there's a
right.
lot of foreign governments that are rethinking their purchasing of the U.S. debt for the long haul with 39 trillion and rising in debt. They're looking out the out years and going, I'm not so sure about that. Plus, I mean, let's be honest about it. And again, this is not political. I don't think there's any use for politics and money. Follow the money. To say that the president has aggravated some of our closest allies and some of our biggest purchasers of debt would be probably a statement that any normal person with half of a brain would agree with. And that's not helpful either, I don't think. And again, there's not to say that he was right or wrong in his positions, just that the foreign the way that the United States is viewed in other parts of the world now is not what it was even 2 years ago. So I think that's something to point out as well.
A little slight pushback on that point when it comes to sovereign nations buying our debt.
Yeah. Yeah.
A lot of people like to make there's a misconception that the sovereign nations are when they buy U.S. debt, they're investing in U.S. government bonds. That's not the reasoning at all. They have to buy debt, so they're going to continue.
It's for safety.
Yeah, they're going to continuously buy debt because well, pretty much what happens is that they hold a bunch of U.S. dollars, and you don't want to hold U.S. dollars. You want to take the U.S. dollars, and so they give it back to us in exchange for bonds.
Right.
That's pretty much it. So it's not for investment purposes, so they don't really care about where yields go and all that stuff. They're going to continually buy. For them, it's just getting rid of the U.S. dollars. But yeah, there's a lot of those risks that are kind of built in there. And then Joe, on your second question is how do we forecast rates or how do markets forecast rates? It's understanding everything that gets built into what the rate is now, and then trying to understand where all those things are going to be in the future. So again, inflation expectations, where inflation expectations are going to be, what yield or what relationship that has between now and what has actually transpired in the future in the future. A whole bunch of is essentially just a bunch of different models taken into a bunch of different economic indicators. The main ones
And
again
as
are
those indicators change, those projections change, right?
yeah, and they're continuously updated.
And I think this is an important part to talk about predicting and then probability, right? So I think a lot of times people look out and say, oh, well, everybody was forecasting for the year to be good. How come they were wrong? They didn't know. Nobody has a crystal ball, or we'd be a whole lot richer than we are. It's a probability game. It's
Yeah,
given a set of assumptions that we think are accurate. Here's what we think could happen within this range. And then life plays out in real time and new information comes into our
mhm,
sphere and it causes deviation from what the forecasts were. So it's probability versus actual prediction.
yeah,
And human beings are notoriously bad at being able to differentiate between what is probable or likely or possible and when they hear the probability of 60%, they think, oh, that's going to happen. Well, there's a 40% chance that it wasn't going to happen. And I know Connor's a big baseball fan. He's a Cardinals fan and I'm a Cubs fan. But if you hit 400 in baseball, you're more than a Hall of Famer. You're the greatest hitter that's ever lived. So that probability of there being a different outcome than what was predicted was actually really, really, really high. And we just don't do a good job of that as human beings, the way that our brains are made instinctually, developmentally, over time. We don't make decisions that way about money in a proper way. They teach you that
yeah.
when you study behavioral finance. And so try your best, to listen really closely to the words when someone's making a prediction or talking about probabilities to realize that there are many, many other possible outcomes. And so you should be thinking about that as you decide how to invest your money. But going back to the interest rates, what has changed this year, Arpit, you can correct me if I'm wrong, is inflation expectations have risen.
Mhm.
So we've gone from this idea that we would be cutting rates because we thought inflation was going to be coming down to the idea that we might be actually increasing them. And the idea that we'll be increasing them to fight off inflation is not what real estate markets had in mind. It's not what equity markets had in mind. It's not what anybody who has to borrow
Yeah.
money had in mind. So you're just starting to see some potential repricing here. Is that what's happening?
Yeah, pretty much. Yeah. In the short term, when rates are expected to be higher than what they were originally, people start repricing stuff, and that happens pretty fast. It's almost instantaneous in the marketplace.
Very, very good. Let's talk about one thing before we move on to the K shape with Mr. Connor. I'm sure you guys are nerds like I am and saw that there was a very large IPO this week in Cerberus. Cerberus makes a very large chip that is meant to compete and help, kind of bit of a series of small chips together that make up the brain that is AI. They're trying to be able to do it all in one larger chip, and it solves some of the memory problems that we've seen, or theoretically, it could solve some of the memory problems that we has seen that have been created by the boom in AI. It came out with a 68% pop on day one. It gave back a little bit of that on day two. We've seen a lot of IPOs in the past come out, bump up really high, and then end up all the way back down where they started. Cerberus was priced at 185, so it came out way above where it was
Yeah.
priced at. So talk to me about Cerberus, thoughts on it, and talk about kind of the IPO market if you know anything about what's coming. I have a couple of IPOs I'm interested in seeing over the rest of the year, but talk about Cerberus and then we'll move on to the K-shape.
Yeah, it's just another big semiconductor play. And again, memory was a really big story so far in
We
the
talked about
AI play.
SanDisk Slack week. I can't say it. Put the
I'll just
explicit in
have to
there.
bleep this one out, huh?
No, we don't bleep. You can cuss on the show. It's totally fine.
Stan,
The
what,
show is
Joe?
not for children. But no, SanDisk, the memory play last week. So go ahead, Arpit, I'm
Them and
sorry.
Micron, right? So we're
Yeah.
starting to see this is just a big memory play, and people are trying to fueling into it. Now, I'll be honest, I don't know the technology that well. I had to defer to that to more semiconductor experts.
Yeah.
But ultimately, it's hard to tell how much of the turn is actually because of a fundamental, I guess you could say, a benefit or a change that the company's about to bring, and how much of it is just AI hype
Yeah.
and semiconductor hype and memory hype. You have three
Yeah.
different hype trains all fueling this one thing. I tend to not trust IPOs that much long term. For the most part, they don't really perform that well in the next few months apart when they tend to perform when they tend to release. But there are some big IPOs coming out this year. We had Cerberus come out, right? And then we have expectations on the big AI chains. You had the Anthropic AI IPO supposed to come out, OpenAI's IPO.
Well, that'd be a big one.
SpaceX
I
is
mean,
supposed to come out, no?
everybody knows. Well, SpaceX is big. SpaceX might be the
Yeah.
biggest ever.
Yeah.
What about Kraken for those crypto enthusiasts? I think Kraken is on the agenda as well. It might be the largest crypto related IPO in history, is what I'm hearing.
No,
So I
no
know you
comment.
I know you have no comment on crypto, but but it could be a big IPO, and I think all of that speaks. I do get questions sometimes from people saying, how do I get my hands on it? I mean, the only way to get that is if the firm that's issuing the IPO has some that they can offer. It's really difficult to get,
Yeah.
especially bigger companies like SpaceX. It just don't. The people who work there have been waiting for a liquidity event for a long time, and they're about to get paid. So they're not really big on selling it. So if you can get your hands on some IPO, you might make some money. But to Arpit's point, companies like Uber, Airbnb have gone public and then made it all the way back down to their pre-IPO price and then below. Because in today's marketplace, the private markets run up a lot before they go public. The public is a liquidity event for those investors that invested along the
Mhm.
way. And so just keep that in mind. I'm not saying that Cerberus or SpaceX or Anthropic, which has really amazing potential usage. Anthropic is Claude, for those of you that don't know. Um, OpenAI is ChatGPT, if you didn't know that. So those things probably have long tails, but their valuations are also sky high, and so it's just something to watch for. Any comments, Connor, on those?
I would say one of the worst things that about what you said is behavioral finance. You brought that up earlier. This is probably the biggest down, for the common investor because they just assume, I think you mentioned Uber. I remember when Snapchat IPO'd and all these, millennials thought it was going to be the next best thing, but they don't understand the valuations and the behind the scenes. And a lot of IPOs, you are going to see the pop first because everybody gets excited, but then the people that have been in for a while are going to sell pretty quickly and take those gains off the table, and you're going to see it go back down. So really not understanding the investing game and how those work, I think can hurt kind of the kind of the everyday investor rather than the, the Warren Buffetts of the world. So just be wary when you hear about these big companies coming out and jumping on the train.
I hear you on that, and but it is exciting to watch. Also, just as an aside, there hasn't been that many IPOs this year. A lot of it is because of the Iran crisis. So we have a backlog that I think is about if the market stays relatively high, you'll see a lot of companies come public, and there could be some serious money made for the people who invested in those companies earlier. One thing that I would point out, though, like on OpenAI, Google was a major investor in OpenAI. Some of those bigger companies that I mentioned have made big investments in to the degree to which they create liquidity for themselves could be important for them. Okay, let's shift gears. Let's talk K-shape. We have been talking about that on the show. Again, Connor, the whole reason why I invited you on is you had that discussion I thought was really good on Fox 2 in St. Louis. So let's just kind of lay the backdrop. I know we've been kind of teasing it the whole show, but again, you basically have I'll put it this way, I'll put it in terms that I feel like everybody can understand. I think about a teacher and a firefighter, and the reason why I think about that those 2 people, doesn't matter whether you're a teacher and firefighter, but if you're in this income range, I grew up in this business that I'm in working with that type of crowd. I cut my teeth with teachers, I cut my teeth with police officers, I cut my teeth with firefighters. These are hardworking people that have a good job, but not like a great job in terms of paying job. And they usually can have as long as I've been in the business, a fairly good life. So I picture a teacher making about 60 grand a year and a firefighter making about 90. Maybe they make 100, maybe they make 70. I mean, but at the end of the day, 150 to 175 a year, trying to raise a family of 2 or 3. And I know because I have raised 3 children and I know how expensive it is. And I ask myself, how on God's green earth are they going to do it with prices where they are today? And so again, the other side of that, you got, these tech people that are making 300, $400,000 a year, small business owners that are making 300, 400, 500,000, $1 million a year. They can absorb $5 gas. They might be pissed about it. They might be bitching about it. But at the end of the day, they can make it work. It's that 150 and 170 and down crowd that I'm like, how are they going to make it work? Now they'll keep spending because you still got to drive to work, you still got to buy groceries, but less of their money gets to go into discretionary purchases, things that they want to do, and more of it has to go in what they have to do. That's kind of the way I view the K-shaped economy. So, what do you think about that? Do we have any tips for these people? Like, what's our ideas?
No, everything. I agree with what you just said. So again, we kind of been teasing it. I guess I'll just kind of give a quick definition. It's really, again, we think of the letter K, that the wealthiest individuals, and Joe, I think you sent this over before this call, but the wealthiest 10% in our country are spending close to 50%. And so that just doesn't sound sustainable to me, when the bottom 90% of income, which again may still be great incomes as you just indicated, but they're not spending near as high. And I just don't see that. And you said it earlier, the wealthy are always going to spend, but that spread is going to keep getting wider and wider. And there's going to be a pullback on that eventually. And I agree with everything you also just said. I mean, as everything becomes more expensive, I mean, a lot of again, I hate to use the word lower income, but, kind of teachers, firefighters, those individuals you mentioned, they can't buy cars anymore or houses or, I mean, look at student loan debt these days. I'm still paying off student loan debt and all these. So it's not even just discretionary purchases to me. It's kind of all these debts that are also compiling on them at the same time. So how can they spend more, even if they do get a promotion or wages go up? Well, great. Inflation also went up and I'm still paying off my house and my car and my student loans. And wait, I have kids now that are going to daycare. And it just seems like, even as your income goes up, your expenses just seem to go up as well. And so I just don't see a near term reprieve from that. And again, not getting into politics at all, but we talk about, prices are too high. Well, it's rare for prices to really ever come back down. Gas is a little bit different than that. And I know kind of eggs we've talked about and things before, but, you're not just going to all of a sudden see car values really come down, new cars or anything like that. So we also have to assume everything will continue to get more expensive, just at what rate in the future. So I'm being prepared. So one of the things you kind of ask is, what can you do about it? Well, one of the things I mentioned is always have that safety bucket of money, 3 to 6 months. I know it's kind of the industry, average that everyone talks about, but if we're going to see some layoffs or recessionary, be ready, but also don't panic. And I think that's the number one thing I can say on any podcast or any interview. We know there's going to be times of up and downs. be ready to weather that storm, understand where you're headed, where your career's headed, and just be ready for headwinds because we're all going to take them on at some point. But if you panic and make rash, immediate decisions, we've seen again 2008, 2009, people would sell out at the bottom. And of course, that's when we would tell them to buy in. Right. And so just kind of talk to somebody you trust, whether it's a financial advisor or I'm sure Arpit can kind of give advice on things that, maybe websites he goes to, but just go, learn, I guess would be my long winded point to this and don't panic in those scenarios.
Arpa, do you have anything to add? Any ideas? I feel like you're a relatively frugal guy, although not in your bourbons.
What makes you think I'm frugal? I mean, yeah, I do agree for the most part. I do think there is a big problem kind of hitting the middle consumer and the lower consumer range. But I do also have, and one thing that I like to do a lot is see the other side. And there is, believe it or not, there's a debate on whether or not is there a K-shaped economy. So I like to ask some questions and see, pick your brain. And
Now you're showing your privilege, buddy. You're on the top side of the case.
so I mean, so one of the big questions again is the idea. First, I want to expand a little bit the definition of the K-shaped economy because there's a lot of ways you can say the K-shaped. Is it more on just a income level side, like based on how or different lifestyles of different income groups, or is it also can it be done on a corporate side? The difference between big companies and small companies, or is it on a well-being side, or a consumption side, or total wealth side? So what is really, and it can be several different types of K-shape. So what is to you, I guess, more so the important K-shaped economy?
Important. Everything you just said is a
Or
good question. I think of it as the experience, like we talked about, the well-being that the citizens out there are feeling. And one of the reasons why I think consumer confidence remains low is because I think everybody has kind of a tuning fork
Mhm.
of prices. And whether you're able to absorb it or whether it's harder for you to absorb it, you still feel it. And so I think it's probably more the well-being. But that is an interesting point you brought up about the corporations, because that's definitely happening too. I mean, as like Claude Enterprise or some of these more expensive versions of artificial intelligence become more available, I mean, certainly a company with $100 billion value is going to have an easier time biting off $1,000 a month, cloud subscription than a company like, say, our size, where that could be really prohibitive and very difficult. And so, I do think that's an interesting thing that I really hadn't thought about before. And one of the reasons why I like doing the show with you, Arpit, and having guests like Connor on is so we can kind of discover these other areas of the K shape.
Mhm.
I find it hard to believe there's a debate that is happening because I think it's happening
Uh-huh.
across all the levels you mentioned. In terms of what's most important for the economy, probably more the corporate one than the individual, but the well-being is where the consumer sentiment comes in. And in my opinion, consumer sentiment seems to matter less and less and less per markets. It used to
Yeah.
matter a lot. It doesn't matter as much anymore because of the K-shaped economy. Like the top just keeps spending, and they don't.
Mhm.
They may be pissed, but they just don't. They don't stop. And it's like, the corporations and companies have found that they can increase prices and that people might not like it, but they'll continue to buy.
Yeah. And when I say debate, it's not really the majority of economists and professionals, I myself included, do believe there is a K-shaped, some level of a
Yeah,
K-shaped economy. But the major questions to it
yeah,
actually focus heavily on labor markets more so
yeah.
than income and everything else. One of the big things is we saw post, COVID, we saw a major, you can say some of the largest wage compression in history, where the lowest level income groups saw the highest wage growth increases versus the wealthier ones. So people on the lower end were making more money than before. And the idea that there's so that's one of the major counterpoints is that, hey, is it really a K-shaped economy if the lower end people are actually they're making more now than they ever were? And the other one when it comes to the labor markets is, again, most of the layoffs we've seen are white collar tech finance job layoffs. Unemployment rate for people without a bachelor's degree, for example, it's fairly low. It was around 4% for most of 2022, 23, 24, and 25. So if there's, again, this idea of this giant K-shaped economy where only the top 10% are really doing really well, then why aren't the big question is why aren't the labor markets kind of showing that? So then this is for both of you. And again, there could be delays in this. There could be you're starting to see that unemployment rate tick up on both sides. You're starting to see general more layoffs. But again, these are good questions to believe or to kind of just research and look up because
I'll
they
jump
are.
in there because I know the underemployment rate is very, very, very high. So you've got a lot of people who are doing something they don't want to do or working more than one job. So that doesn't always
Gig
translate
economy.
in the data. We talked about that last week, and so I point that out. Connor, I don't know if you have anything you want to add there, but I think I'm just going to repeat one thing that Connor mentioned earlier: is that half the spending is coming from that top 10%. That's an undeniable stat, and it means that in the aggregate, this is a problem. I don't know about individual cases, and there's resourceful individuals who will find a way. So, Connor, if you have any comments on, is
Not
it
really.
real? Is it not real?
This was a learning session. I liked what Arpit just put out right there. That was kind of
Yeah.
some interesting statistics, and kind of does make you feel a little bit better when you put it that way, Arpit. And again, if we kind of go into more blue collar jobs, to your point, it sounds like those did have higher wage growth, and those are the jobs that we're seeing less people go into. So you're probably actually going to be able to make a little more. I mean, I've got welder clients that do phenomenally well, construction business, all those things that AI can't really take those jobs, also. So I think that can also give some of our listeners probably some confidence that work in those types of industries. Whereas Arpit, you just brought it up, and I kind of said this earlier, as the AI boom, continues, I could see some of those tech jobs being the first ones to go because their jobs are being quite literally replaced, and they just might not have a skill set in another industry or area to go work in. I mean, I can't swing a hammer. I can promise you guys that. So
Yeah.
I don't know. I thought that was a good learn.
Don't sell yourself short, Connor. You could do it.
Yeah, I could. Yeah, there'll be. I didn't even hang these behind me here. So,
You
I
could
just
swing a
think that
hammer,
that's
maybe you just
something
can't
that,
hit the thing.
yeah, that I didn't think about until Arpit, you kind of just mentioned that, and it does make me feel a little bit better. But again, going back to that stat, if the top 10% are doing 50% of the spending, it's not sustainable at that rate. Or eventually they're also going to buy all the crap that they want. So they're not going to spend it on discretionary things. And where does it go then? So, again, that was kind of a long winded, answer to what you just said, Joe. But I just do think that going back to the K shaped economy, we just need to be prepared and understanding of what that looks like in everybody's industry and how that's going to ultimately impact you.
Well, I'm going to start to close. We're not going to close real quickly, but I do want to give a couple of tips because I did spend some time thinking about this. I'm in the middle of writing a book on basically the journey that you go through as a young professional or a young welder, plumber, whatever path you choose. And if you're a listener and you yourself are in your 20s or maybe even your teens, if you are somebody who's in their 50s or 60s and you have kids that you're wanting to teach this to, I started thinking about this as I was writing the book. And so I had some of this kind of fresh in my mind. Number one, shop everything. I know it takes a little time, but we do live in the era of AI. So you can get help from ChatGPT or Claude on shopping your car insurance, on shopping your homeowners insurance. If you're lucky enough to own a home, you can make those decisions about how to get less expensive protein at the house. Because I know we're in a big protein boom. The memberships at Costco or Sam's where you buy in bulk takes a little planning and a little time, but you're going to save money on groceries that way. And the delayed gratification. My son is 22 years old. I've said it many times in the show. He actually graduated with his master's this weekend, and I was out there in Waco celebrating with him. Same kind of thing. It started on savings pattern early. Connor mentioned getting that 6 to 9 month, or I'm sorry, 3 to 6 months. I always say 6 to 9 months. And if you've ever seen the show Madagascar, I had babies growing up, 69 months. So 6 to 9 months is what I am trying to tell everybody. 6 to 9 months of savings. That way, if you do lose your job, you can find a new one. But getting started early on saving for your retirement as well, you can't ever get back that time. So delay the gratification of spending. You should, if you're 22 or 23 years old or 18 or 19 years old starting your job as a welder or a construction worker, you shouldn't be concerned one bit about whether the economy grows or not. You're concerned only about yourself and how you take care of yourself and your family. And then when you get to a point, later on, then you're starting to invest. Then you can start caring about the economy and worrying
Yeah.
about who the president is and what the Congress does. But those are some of the tips that I have: is be frugal, practice it, be resourceful, and research ways to make it work within your budget. Far too many people will not delay the gratification. It's part of the cultural problem. And Connor held up his phone earlier and talked about how social media puts everything in our face nowadays. And we are all guilty of looking at what somebody else is doing, what vacation they're on, what kind of car they're driving. Also, we're being marketed to and manipulated. So understand that's happening and then don't allow it to happen. The first step to not being manipulated is to know that someone's trying to manipulate you. And whether it's the political systems on both parties or whether it is the large corporate America, they want you to behave in a certain way. They want you to think in a certain way, and they are putting things in front of your eyes that are going to try to make that happen. You have to challenge yourself. You have to think differently. So that'd be my tip for all of our listeners and for all of our audience about what to do in this K-shaped economy if you find yourself on the bottom side of that K. If you're really on the bottom side of it, you're working in fast food or you're, which is hey, I worked at McDonald's when I was in high school, and there's nothing wrong with that. I would be thinking, I would be going to these AI chatbots and saying, how do I get into a position where I can make more money? Because if you're really truly at minimum wage or right around minimum wage, it's almost hopeless to try to break out of that. I mean, you are spending every dime you have surviving. And so the next step for you isn't saving or getting a 6 to 9 month um, emergency fund. The next step for you is, how do I get into a job where I can make more money? How do I give myself a skill where I become more marketable? Instead of making $17 an hour, I can make $50 an hour. 'Cause then you could actually start thinking about how to improve your financial life. And everybody goes through those steps, and somebody will come in and fill behind you and work in those jobs as you move your way up. But that's my advice to the listeners that are out there on how to deal with this, because I personally don't think it's going away. That was long winded. Sorry, guys.
No, and one of the things I love that you just said there is routine and discipline at an early age. I met with a police officer client of mine a week or two ago and said something along the lines of, every paycheck, if I had $150 of discretionary income, 100 went into my investments. And he just trained himself to live off of that amount and to start investing early. And now he's in a really great position, getting closer to retirement, but also passing that mindset down to the next generation. I think we do a terrible job at teaching kids finances at a very young age. And one of the things I can remember going to, Mizzou, I went to the University of Missouri. It was like the first day I'm walking to class and there's like a Discover credit card. Sign up today for your first credit card. And I just almost can't believe that's legal, because these kids are taking on massive amounts of student loan debt, more than likely, already. And then the first thing they see on their walk to class is open your first credit card, start building debt. And I just, if you don't understand the mindset or haven't been trained on that, and you don't have a routine or discipline, it's very easy to get yourself in a bad position in your early 20s, and digging yourself out of that to even get to the point that we've been talking about on the rest of the podcast. I'm kind of getting for retirement and everything. You're just way behind the 8 ball already. So try to pass down the best financial advice that you can at a younger age for your kids, because I just find that to be extremely important and passionate, if you can't tell.
Well, I think that's a good spot to end. What to look for this week: Nvidia, which is the largest company in the world based on market capitalization, correct, Arpit?
Yes, sir.
And they are reporting earnings on Wednesday. So when we give the show next week, we will have Nvidia's earnings. They have blown out earnings pretty much every single quarter. I actually expect that to happen again, but that does not mean the stock will go up. So it's sometimes by the or when they say sell the news, but we'll see what happens there. I think we also need to pay attention really closely to the bond market this week. If we continue to see the 10-year and the 30-year moving up, that is a sign that it is not a pretty picture, and the markets will have a really hard time continuing to march forward if we continue to see that pressure upward. I think always pay attention to what's going on in Iran and the Strait of Hormuz, because there can always be a surprise good news there where some sort of deal is struck, and then we end up seeing markets rally. They've kind of preemptively rallied on the idea that this thing will eventually resolve. But this week, I think that's the two big things to watch: the 10-year. The 30-year matters too, but the 10-year matters more because the 10-year has a lot to do with like mortgage rates and things like that in the country. But pay attention to NVIDIA on Wednesday. I think that'll be worth watching. We'll be back next week with another great show. Thank you, all of us, for listening. If you don't mind, as we start to grow in our audience, go on to Spotify, Apple, or YouTube and say that you like us. Leave us some comments. Ask us what you want to hear about us. If you don't like us, we want to know that too, man. Say, hey, Joe, I don't like your hat. I don't like your stupid shirts. I don't like your political takes. I don't like this or that. I got thick skin. I can handle it. So I don't know about Arpit. He may be a little more thin skinned than I am. So maybe he might cry on air. We'll see. See you next week, guys.
Thanks, guys. This was
Take
fun.
care, yeah.
Thanks.
Bye bye.